What is up, YouTube? What is up, guys? The Composure Trader here, and welcome back to another post trading analysis video. Now, if you have not noticed already, I have a slight music going on in the background. Okay, I'm just testing it out, kind of to see what the vibe is when I'm recording, which is a slight, background music. It's a nice relaxation playlist, and it's sometimes also music I listen to when I'm actually trading because, especially for beginners, trading could be pretty stressful and pretty nerve wracking. So if you have, a playlist that's pretty relaxed that can actually help you get in that relaxed mood and that vibe that you need to be in order to trade correctly. Okay. So we took a trade today on gold. It was, in my opinion, a pretty easy setup. There was just one thing that I think the data feed changed. Like, I'm pretty confident the data feed changed for some reason. So I'm curious what that looks like in replay mode because I couldn't find proper market structure pools when someone pointed it out to me. But let's just get straight into it. And as always, let's build some context first. So the general context on gold is pretty simple. From a macro standpoint, obviously we're in a very massive high time frame uptrend, and we left behind range demand. And currently, as we speak, I think our daily market structure low is right here, and that is protected by nice structure demand right here with that breaker structure that push price up pretty aggressively. Now, going on the 4 hour, kind of 4 to 6, you can see that price moved up, and this is very tempting to pull as your market structure pull. But on the 6 hour, from high to low, it's only one candle, so it's technically speaking not a market structure pull on this time frame. But what we basically have is a massive move up, leaving that range, and then a low, and then price returning back to that equilibrium, confirming this mid to high time frame range. Okay, so that's kind of what gold has been doing. It has just been ranging, and then even going more in depth in this range, it has been ranging within ranging, because looking at this most recent rotation, we have a low, lower high, and a lower low. So from there, we pull our range from bottom to top, and then this has basically been our range where we had a model 1 accumulation at the bottom right here that went over into a model 1 distribution right here. Let's make these dots perfectly. There you go. So that's kind of what happened, and especially when you have a range within a range, and then inside of this range you have a very aggressive sell to buy, kind of having an accumulation and a distribution. In this aggressive formation, you can expect price to just cool for a few days, right? Just cool inside of the range. So it's like we had an accumulation that hit its target. We have a distribution that could hit its target or potentially could go over in a more extended accumulation. But I was expecting this consolidation to happen because we had these aggressive sell to buy moves, deviating the extreme points on both ends of the range. Okay, so whenever I have this and I have those aggressive deviations on each side, I kind of just focus on the lower time frames because I just know I'm within the range. Like, the context doesn't matter that much anymore. I'm really just trading the lower time frame and identifying potential TCT schematics on the lower time frames, knowing that I'm in a high time frame range. So we can kind of extend this to the extreme points, get rid of the equilibrium because that will be in our way, and then zoom in on like the 10-minute. So when I was checking the 10, I was like, okay, what do we have here? Because price is kind of moving down, moving up, moving down. Like, Monday was pretty volatile for gold because pre-London we had to move down, we had to move up, and we had a very aggressive move down again, and then the move up again, which is like, what are we creating here? We had a distribution yesterday here, but it never got confirmed. We didn't have market structure to wait for, but we did have a nice little 1, nice little 2, and nice little 3 with a very aggressive move to follow. Now, from there, we had a very aggressive move down. So I kind of saw this as it's just its own little thing. Okay, this was its own thing where on Monday we had the range here. This was our local range right here. We got the deviations, some sort of like a PO3 formation, right? Kind of a range manipulation expansion play. Didn't really get a confirmation for that. Wouldn't also have traded it. And then that went over in a distribution in here. And then we had the aggressive move down. So that's kind of its own thing. I don't want to use that price action anymore for my range today. Okay? So I was really just focused on that last move, which is that move down. And then we got the move up. And from there, we have our range. Right there we have our range, and this also looks the best, right? Just looking at it from a range perspective, do you want to pull your range all the way from up here and then identify these points and combine them with this, or just focus on this as its own little range? Because in my opinion, focusing on this own little range, you can actually see that price is respecting this range. Like, we're actually going sideways while having one deviation. So, you know, it's kind of playing around a bit when you are just literally ranging, to build like a foundation, a layer, to have some things on your chart that can give you, you know, some more information. But, you know, coming into the day, this was really what I was looking at. So I knew that I had a range and I had a deviation of that range low. And we also left right here extreme demand. Okay. So right here, I knew that we were in the discount section of this macro range. This was the most clean local range, and we deviated the low. So it's looking like an accumulation as of now. Also, looking at liquidity, I could immediately tell that we had these nice highs up here. Nice highs up here that caused some nice buy-side liquidity. And then looking at supply and demand within the range, we also have this 3-minute supply zone right above those liquidity highs. Let's make that supply right above those liquidity highs that price could tap into and reject from. So this was kind of my foundation of this range, and then we can zoom in even more, right? Because overall, yes, we are more bullish than bearish, you know, a more bullish bias and a bearish bias, because we are in the discount section of the macro range and we have a deviation of our range low. But if we want to have a proper accumulation schematic, price has to tap at least this extreme demand because the extreme liquidity is below it. So if we can get a short confirmation in here with a 1, a 2, and a 3, we can still take that with our target being this extreme demand POI, because price has to get there in order to actually properly accumulate. And then from there, we could have a long and take it back up, sweeping all these buy-side liquidity highs. So just because we are watching this accumulation, don't neglect the lower time frame that could potentially give you a short that you can take into a long. Okay. So zooming in, I was checking my market sessions, and I was like, right here in that Asia session, we have this 3-minute order block. Okay. So I came to the charts at 7:20. There we go. So I came to the charts at 7:20, and then I identified this range that we had. And I had a range low, or a range high, range low, and we got that deviation 1. So what I was hoping for was price pulling back. There you go. Price pulling back. We extended. And I was hoping for price to have a model 1 into that supply zone, get a confirmation in here, and then take it all the way down to X marks the spot. Okay. Looking at the range itself, we also had a lovely return to zone where these lows are all higher lows, leaving behind lots of sell side liquidity, meaning it's no support when we're coming down. Okay, you take that first low, and the liquidity under that low will cause price to spike down to the next low, and then you have that snowball effect coming down. So I was watching for a potential model 1 here. And it was mainly a Model 1 because we had that supply above, but also there wasn't really a clear POI for the third tab of the Model 2. So whenever there's no clear POI where price could reject from for the Model 2, I'm always just looking for a Model 1, okay? And zooming in here, we got that third tab that did not sweep or did not mitigate that supply zone. That was unfortunate. But look, I swear they changed the data feed. I swear they changed the data feed because right here, I put my breakup structure right here. But if I go on my X profile, like look right here. This was a bullish candle. You see this candle right here on my mouse? That was a bullish candle. And right now that is a bearish candle. That was not a bearish candle in the moment. Like, you can even see it, right? Right now it's like an actual bearish candle. You can clearly see the bearish candle. And then right here you can see how thin it is. And I'm using the same exchange. It's FX. It's FX. It's very weird. But this was market structure when I was watching it. So it's very strange how that changed. But yeah, right now this is not valid market structure applying the 6 candle rule. But when I did it, it was. So I don't know what went on there. But we had the Model 1. We got that break back inside our volume profile. We had to return to zone. And also the timing was lovely. I always tell you guys that regarding timing, you know, 1 hour before your London Open, or just in general 1 hour before your session open, price loves to have aggressive moves and entries, and then when the session actually opens, it just completes the move. But the entry was actually prior to it. So I entered right there on that break. I put my stop loss above the high, and then I targeted the low for a lovely 2 risk to reward. Very simple, very nice 2. Now, I knew it had the potential to run down towards this extreme demand POI, which was the POI for the higher time frame Model 2 to actually take place, right? So I went short right here on 2 position sizes, and then I was going to take 1 take profit here and 1 take profit here. The problem is price came down very easy and very aggressively, hitting the target, but literally price was right here, and my take profit limit was still not triggered. It was very frustrating and very annoying that I took profit, I had limits right here, and then price actually exceeded that limit by a lot, and I did not get filled. So it was very annoying because then I decided to market it, but then when I marketed it, it was right up here. So very annoying price behavior from MT5 regarding ACG. So that was the only struggle, because I was getting frustrated, right? Especially when price started pulling back, of like, yo, why is my first TP not hit? And then I kind of just exited the position, while I should have actually let one position run down all the way down to here. Okay, so that was on me. That was a point of improvement, but I was just annoyed that price was literally way past my take profit order, and I was still not filled. So yeah, that was a mistake on my end by marketing out, because I knew it had the potential to come down to here, so it would have been filled at some point. But normally that's not a real problem. I don't know what was going on with like the spreads and all that stuff. But yeah, it was a Model 1 distribution. We had to return to zone. Timing was good. And also pay close attention to the fact that even though we did not mitigate supply, I still took it. You know, it was just nice extra confluence that there was supply up there. And I would have preferred it if it hit it, but it's not something that causes you to not take the trade. Okay? So from there, I was expecting a bounce in here, right? But in order to confirm that higher time frame Model 2, you would have to break structure back to bullish, which is at that moment in time following the 6 candle rule all the way up there. And then they would just continue. Price just dropped, and it dropped even more, very aggressively. So there was no confirmation for the Model 2. and that trade could have actually netted me way more than it ended up doing. So I have definitely noted that down as a point of improvement. But either way, 2% a day keeps the day job away, right? So deleting all of this, the fact that this cannot be an accumulation anymore is wrong, because it can always be a Model 1, right? So even though the Model 2 failed, maybe it wanted to do a Model 1, where right now we also swept this extreme range low, right? So we could have a potential Model 1 while sweeping our extreme range low POI. So that's always just nice little extra confluence. The problem is that we didn't have really good market structure. So this is not market structure. This is just price going literally sideways. So your market structure is all the way up here. And you also have to be aware that because we came down so aggressively, we left behind supply from that Model 1 distribution that we traded. So when your market structure high is all the way up there and you left behind supply, you know you're not going to get an entry ASAP. Okay, like you just know that entry is not happening ASAP. It is nice that this buy side liquidity trail extended itself even more. So now we have 4 highs where each high is a lower high compared to the previous one. But you have to be patient right here. So at this moment in time, London also actually opened. We swept the Asia low right here, which is nice little extra confluence for the trade. But we have to wait and we have to be patient. Now, mind you, I did not end up trading anymore today after that 2% gain. But as you can see, price ended up coming down once more. Okay, now, does this make this an invalid TCT schematic? Absolutely not, because I always tell you guys to check the highest time frame that your range is valid. So now, if I go on the 15-minute, or I go on the 30-minute, or what is it, the 10? The 10. If I go on the 10-minute, there you go. You can see that on the 10-minute, we have that pull up, and then we have the move down. And this right here is not a valid deviation on the 10, because you don't have the 6 candle rule. So this is on the 10-minute, it's just one move down, making this still a valid Model 1. And that always becomes way nicer, because now we actually have more local structure to break back the bullish, which is right here. And you can clearly see this V-shaped recovery. Like if I draw my drawing tool out, you can see price went from a sell to a buy, which is a lovely sell to buy. And for the people that remember, I once told you guys that if you have a Model 1 where the third tap has this V-shaped recovery, it loves to respect market structure from the low to the high. Okay, it's very aggressive, so it doesn't want to come back anymore. Okay, it's very, okay, we break it, we have a local pullback respecting market structure from this low to this high, and then we just go higher. So the move was so aggressive that we barely even created market structure. Like this is probably like 30 to 15 second market structure right here. So I think price would even respect that. Let me see. Yeah, so you can see price even respected that market structure on the seconds time frame because of that V-shaped recovery. Now, the beauty of it is I would have not entered, and I did not enter right here because the RR was a bit less good. You know, even if you entered here, your stop had to go here, and I would not even target the range high or target these highs. So it is a 2, but I want you guys to pay attention to the difference in the 2, because this trade, oh, I'm getting a call. 1 second. One second, guys. Let me say I'm almost done wrapping up. I'm recording a video. 1 second. Okay. I think we're back. Where's my music? Well, my music just left the chat. Testing mic. Well, I have no more music after that call. Oh, no, there we go. Okay, it's back. So I want you guys to pay attention to the difference in the two. So the difference in the two is that this is a 2 risk to reward, but in order for this trade to be completed, price has to move 0.55% compared to the other 2 risk to reward, where price only has to do 0.13%. So this one is like 4 times as big. Price has to move 4 times as much for the same risk to reward. So I like to keep my trades very narrow and very, how do I phrase this properly? I like to take trades that have a great risk to reward on small movements, okay? I would only take a position this big if it was like 4 to 5 RR, because that way halfway through you're already at the 2. Unless it's like a crazy high probability setup, obviously, but right now you even had the supply, it's only a 2. So price did ended up actually completing this move, if I'm not mistaken. We sliced through that and we swept all liquidity. There you go. Now, gold actually had some crazy moves today, because this is literally a trade that I missed, but we came into that extreme supply, and coming in that extreme supply, we actually created yet another range, as you can see right here, where if I go on the 2, it becomes a bit more clear. I think it's on the 2. Where we have a 1, we have a 2. Man, are they... I don't know what's going on with this data. Let me double check. Because this is not a valid pullback on the... Yeah, so it's really a 1 minute move. But I thought... I swear this was a 2 minute move as well. I am 100% confident this was a 2 minute move. Because you got a little model 1. However, it was only a model 1 on the 2, because you had the valid pullbacks in between, but now this is not a valid pullback anymore. Otherwise, if you go on the 1, it's not a valid TCT model 1 schematic, because on the 1 you actually have 1, 2, 3, 4. So only on the 2 disappears this deviation and turns into 1. But apparently it's not anymore on the 2. Like, something changed with the data feed, guys, which is very strange. But yeah, this TCT model 1 did not end up hitting its technical target, which would have been this range high. But either way, I wouldn't even target the range high, because like this supply zone is so close to the range high, and you have supply with all this buy side liquidity above. Why would you target the range high? Just target the extreme liquidity point and the extreme supply, especially if you see price starting to distribute coming into that POI, okay? And exiting replay mode from there, we actually dumped down. So yeah, we got the back test, and then we just continued our way down, now actually losing this range. So I'm very curious what's going to happen here. I pulled out this demand zone on the left, which was it's kind of the only demand I was really watching. I don't know if there was something in here. Let's check. That 45 is mitigated. 30 is mitigated. Nothing on the 15, nothing on the 10. Yeah, there's nothing that's significant in here, but price is bouncing at the moment from it, but it could have just been more of a relief rally. So now deleting all of this price action, this is kind of what we have, right? So most likely we have some supply creation right now because of the aggressive dump. I'll just be focused on the lower time frames going into London tomorrow. We do have a massive liquidity trail right here of buy side liquidity, and technically speaking, we haven't really lost the range. This could be still a deviation, but in order to actually trade it, price would have to do something like this, come back inside and then create a bigger range where we could tap into this extreme demand creation, for example, and then trade it as a 1, as a 2, as a 3. That would be lovely if we could create this massive buy-side liquidity trail that's like tightening up in this formation, and then we can get that breakout and then run it back up. So because we still are in a macro uptrend, right? But we have to just wait and see what price is going to give us. And that's also the key to trading, right? Preparation. Like, I prepare all these moves in advance. So when the moves actually happen, I'm so calm because I was already mentally prepared for it, right? And then when you just put on a nice little calm background music and you know that you're going to stick to your plan, it's just a matter of execution, right? Trading does not have to be that crazy where people are stressing and yelling and all that stuff. No, we can just keep it simple, be patient, only wait for high quality setups, and then take the trades. So I don't know what this box is. Maybe from one of the tutorials of the TCT. Oh yeah. Yeah, let me put that away. So I can actually delete that now. Remove them. What is this other group? Yeah, I can remove those now. And yeah, that was it for this post-trading analysis video. If you liked the background music in this video, let me know, then I'll do it more often, okay? If not, also just tell me and I'll just stop playing that background music. Maybe if you play me on like 1.5x or 2x speed, it's a bit annoying having the music in the background. So let me know and I'll adapt to whatever you guys want. And remember, the TCT is launching Friday, so I'll see you guys on the other side. Peace out.